Hi there, Etoro. It is Monday, the 5th of December, and that means it's time to take a look at what moved the markets last week. Now this week, I'm going to begin by talking about a few companies in my portfolio that reported earnings, and then I'll move on to the more general information. The first of these companies is EasyJet. So EasyJet is a budget airline within Europe. They're one of the larger players, and like many airlines, they've had challenges through lockdowns and then through this year because demand grew so rapidly that they had trouble in servicing that demand by, for example, hiring people quickly enough. Demand grew so rapidly through this year that airports such as Heathrow had to put a cap on the number of routes and passengers they would let pass through that airport. Despite this, looking at EasyJet's full year statement, they've had a really good year. First of all, the number of routes traveled and airline passengers is approaching levels last seen in 2019. 2021 was a very difficult year for the airline and just about all airlines. And in that financial year, they reported a loss of £1.1 billion. However, for the financial year just gone, they've reported a headline loss of £178 million. Now, many people might be saying, what's so great about a company that's still making such an enormous loss? Well, EasyJet, like most airlines right now, are turnaround plays. What we're looking for here are the best of the best airlines that will make it and succeed beyond this very difficult phase that all of them have had to go through. Now, the reason that I think EasyJet is one of the best airlines, particularly within Europe, is that, first of all, they have one of the strongest balance sheets within European aviation. I think the only one that's close to them is Ryanair. They've learned a lot of lessons from the very difficult 2020 and 2021. And they've also made some very clever investments through this difficult period. It's cost them some money, but it looks as though they are starting to reap the benefits of those investments. One of those areas that seems to be bearing fruit are EasyJet holidays. So these are packaged holidays. They're a particularly high margin for this industry, and they expect it to grow 30% year on year. Now, despite the good numbers and the company definitely moving in the right direction, the stock did drop on the day a little bit, and that's because they did say that they think that fuel price is going to go up for them 50% year on year in the first half of next year. This will obviously impact margins, and it'll slow down their ability to pay down their debt. So challenges do still exist for EasyJet, but I think it is one of the best. Airlines are not going away, and I think given the drop in share price that they've experienced, they are a good investment for the next few years. Another company that reported earnings in my portfolio was Salesforce, stock ticker CRM. The earnings that they presented were pretty good, actually. The forecast was a little bit more mixed, but the stock did drop quite a lot post-market and the following day when markets reopened. And that's largely because the co-CEO, Bret Taylor, has signaled that he's going to leave the business. Now, the reason that the market doesn't like this is because he is the second co-CEO to leave the company. The CEO of the company is the founder of that business, Mark Benioff. He's run the company for the past 23 or so years. He's built it into an absolute behemoth of a business, but the market really liked Bret Taylor, who came into the company through an acquisition because he was really entrepreneurial. He was seen as someone that could take the helm from Mark Benioff, who could then step back, and Bret Taylor could go from being co-CEO to being the only CEO of the company. We still don't know exactly why Bret Taylor left the company. He said that he intends to pursue entrepreneurial interests, and that's probably what he is planning to do. I suspect that he made a few $100 million out of the acquisition of Twitter by Elon Musk. He was an investor there, and he probably wants to take some of their cash and start his own thing once again. These types of people like to build their own companies from scratch. In terms of the actual earnings, so they weren't stellar, but they weren't awful either. And Salesforce has a very sticky kind of revenue. They have a subscription model, and they count many of the world's largest businesses as their customer. Salesforce tends to grow when their customers grow, and now because we're going into this enormous growth slowdown, potentially a recession, Salesforce revenues will probably either stagnate or grow very slowly. However, when the economy turns once again, they are one of the best positioned companies to take advantage of that, especially given the enormous decline in their stock price through this year. What I also like right now is that an activist investor has taken ownership of a large chunk in the business. Now, activist investors usually do this when they believe that a company is fantastic at its core, but that the business is able to squeeze a little bit more value out of whatever it sells. So in this case, the activist investor, Starboard Value, has said that The company has grown its top line at a compound annual growth rate of 38% for the past 20 years. They love this company. It's a massive success story. But they also believe that the market is not recognizing the opportunity for significant margin expansion. The truth of the matter is that Salesforce has focused on growth for a long time, growth in revenue. And this means a combined investment in the company itself, so lots of R&D expenditure, but also in M&A, mergers and acquisitions. What these activist investors and other investors in Salesforce now want is Salesforce to slow down the focus on growth in revenue and start focusing on growth in profitability. So they've effectively bought themselves a seat at the table, a large enough seat that they get to vote on critical issues and have a say on critical issues, and they will be guiding the company towards those decisions that increase profitability. I think it'll be a very interesting year for Salesforce, so they're definitely still a hold for me, and I will be adding to my position through next year. The final company that I wanted to talk about is UiPath. So UiPath is a business software as a service company in the same way that Salesforce is, although the domain of expertise is slightly different. For any of you that work at very large enterprise companies, you will be entering data at some point in your job. Maybe you will be modifying data. Sometimes you'll be entering the same data into several different locations. No doubt Excel features somewhere in that business process too, maybe more than once. And the thing that UiPath offers are software robots that can automate these boring, error-prone processes within a business. So instead of an enterprise having to integrate many different back-end systems, UiPath's offering is, let us configure one of our software robots. It'll behave the same way that a human does. It'll click into fields, it'll enter data, it'll open several applications and move the data all around those various applications, just like a human would. Now, this is very compelling for those businesses that have a lot of data entry or data manipulation, because they can then reduce the part of their workforce that works on those tasks and automate them through software. I didn't expect a lot from UiPath's earnings, but they did surprise quite nicely, actually. So they beat on earnings, they were profitable for the quarter, and revenue grew 90% year on year. This is quite an amazing feat, given that we know that globally spending is slowing down right now. Looking at the most important numbers at a glance, so revenue, as you can see on screen, $263 million. Revenue growth rate year on year, 29%, but that does exclude the FX impact. So as we know, the dollar has been quite volatile through the past few months. Their net retention rate is very strong, and for this kind of company that has a subscription model, you want to know that people aren't buying the service 1 year and kicking it out of the door the next year. And their ARR has reached $1.1 billion. Now, ARR, and I'm not sure if you can read the notes, annualized renewal run rate, is a figure that's used to normalize revenue numbers within fast-growing software companies. As an example, if your company pulled in $10 million in January and then pulled in $500 million in December, and you expected your revenue to continue growing from $500 million per month going forwards, then ARR becomes a very useful measure. Overall, a very good earnings report for UiPath. They are definitely the leader within this very fast-growing industry, which is automation of business processes. The market right now isn't very kind towards companies like this, fast-growing software companies, but they are proving that despite the difficult operating conditions, they continue to grow, and this is definitely one business that I'll be investing more in through the coming year. All right, I've spent quite a lot of time talking about earnings, so I'm going to fly through the next portion of the video. The NASDAQ, the S&P 500, and the CSI 300 all up for the week through to Friday last. The dollar continues its decline. It's now down 8% from the highs that it reached, and this is very, very important to asset prices. A lot of things in the world are priced in dollars: oil, gold, and obviously US stocks. The world also sells a lot of things to the US, so a lot of things are imported by the US, and it buys some things from the US. The strong dollar has been very good for the US because it makes anything outside of the US that the US buys cheaper. So a strong dollar has been very good for US inflation and terrible for inflation everywhere else. A strong dollar also means that if your country holds US dollar denominated debt, and the interest repayments are also in dollars, and you need to convert your currency, which is getting weaker against the dollar, into dollars to pay the interest, that your debt burden is increasing in size. So the net effect for the rest of the world outside of the US is that a weekly dollar is good. In terms of the macro data that we saw out of the world, well, part of the world that I watch last week, we got a lot of different pieces of jobs data out of the US. And although some of the jobs data did exceed expectations, the trend for employment in the US is most certainly down. We got a number of other very interesting surprises. So Germany's CPI inflation lower than expected, GDP within the US stronger than expected, and the core PCE price index lower than expected. This is a measure of inflation. So a really weird mix of data. In some areas, inflation lower than expected, but jobs and employment within the US still stronger than expected. But what the market was really focused on, waiting with bated breath for last week, was when Jerome Powell spoke on Wednesday evening. So you can go through the entire speech. Every speech that he gives is up on the federalreserve.gov website, but the gist of it is inflation is still high. They want to see more evidence that inflation is going down, and that's what they keep on saying, so nothing new there. He also said that the labor market, the jobs market, seems to be stronger than they would expect at this point. And that strength means that they're going to have challenges in reaching their 2% inflation target over time. But right at the end, the thing that he said that the markets really wanted to hear was they're going to slow the pace of rate hikes, and that could be as early as the December meeting, although it will be data dependent, i.e. he will make that decision based on employment data as well as inflation data between now and that meeting. One of the other big ticket items to happen through last week and over the weekend is that China continues to relax the restrictions around their zero COVID policy. There's been no formal acknowledgement of them reducing the severity of these lockdowns, but on the ground, various requirements are being loosened or scrapped entirely. Because of this, we've seen several Chinese stocks rally very strongly through opening today. One of the challenges that we might see with the Chinese market reopening is the fact that China is a big consumer of stuff when their economy is properly open. And that's why we are seeing the price of certain commodities rally off the back of this news too. So lots of metals, for example, and also potentially oil, which would see a big uplift in demand from a fully reopened China. Okay, so what about this week? Well, we are in December, so things are going to start getting a lot more quiet, particularly for the last 2 weeks of December. The market will be looking quite closely at the jobless claims data out on Thursday of this week and the PPI data that we will see on Friday. But beyond that, there isn't a lot in macro terms that I see moving the market through this week. All right, that's it for this week. I hope you have a good one. Goodbye.